EURUSD was seen oscillating in a narrow trading band through the early European session. Investors seem to have moved on the sidelines ahead of the US consumer inflation figures. The US CPI would influence the Fed's policy outlook and provide a fresh directional impetus. The EURUSD pair struggled to gain any meaningful traction on the last day of the week and oscillated in a narrow trading band, below the 1.1300 mark through the early European session. Investors now seem to have moved on the sidelines and waited for a fresh catalyst from the US consumer inflation figures, due later during the early North American session. The markets have been pricing in the possibility for an eventual Fed liftoff in May 2022 amid worries about the persistent rise in inflationary pressures. Hence, the US CPI report would influence the Fed's decision to taper its bond purchases at a faster pace and strategy on interest rate hikes. This, in turn, will drive the US dollar demand and provide a fresh directional impetus to the major. In the meantime, hawkish Fed expectations continued acting as a tailwind for the US Treasury bond yields. This, along with the prevalent cautious mood, underpinned the safe haven greenback and capped the upside for the EUR/USD pair. Mixed headlines on the Omicron variant of the coronavirus kept a lid on the recent optimism, which was evident from a softer tone around the equity markets. On the economic data front, the headline German CPI fell 0.2% in November and rose 5.2% YoY, matching the original estimates. The data, however, did little to impress the Euro bulls amid a more dovish stance adopted by the European Central Bank, ECB. Policymakers have been pushing back on market bets for tighter policy and talked down the need for any action to counter inflation. This, in turn, suggests that the market is unlikely to react to ECB President Christine Lagarde's comments at an online event. Technical outlook. From a technical perspective, the overnight pullback from weekly lows and acceptance below the 1.1300 mark favors bearish traders. Some follow-through selling below the 1.1260 to 55 region will reaffirm the negative bias and accelerate the fall towards retesting weekly swing low, around the 1.1230 to 25 region. This is followed by the YTD low, or levels just below the 1.1200 mark touched on November 25. A convincing break below will set the stage for additional losses and drag the pair to the 1.1145 support area en route the 1.1100 round figure mark. On the flip side, momentum back above the 1.1300 mark is likely to confront resistance near mid 1.1300s ahead of the 1.1380 to 85 area, marking the 38.2% Fibonacci level of the January 1692 to January 1186 downfall. A sustained strength beyond, leading to a subsequent move above the 1.1400 mark could push the pair further towards the 50% Fibo level, around the 1.1440 region.